Hello, everyone. This is Stacy Francis. I just want to say thank you for joining our webinar today. I'm going to ask you a few questions, and the first question I'm going to ask is, can you hear me? And if you could just answer to that yes or no. And this is something that you'll use in your meeting chat bar. This meeting chat bar is something that's very important. It's something that you can use to ask questions to me, Stacy Francis, throughout the meeting that we have today. So please do feel free to go ahead and ask questions. So again, if you could possibly answer that question that I have, can you hear me? And we have quite a few guests already here on the line. And I'll just make sure that we, again, have everybody on board before we get started. Welcome again. This is Stacy Francis of Francis Financial. We are here today to talk about our first quarter 2014 review. We're going to be talking a little bit about what the quarter brought forward to us for this first beginning of 2014 and what we expect going forward. But before we get started, I invite you to use your meeting chat bar. That is a wonderful feature of the webinar materials that we use and the software. And the question I have is, can you hear me? And again, if you could respond by typing in that bar, yes, I can. That will be helpful. I want to make sure that everybody here on the call, we've got quite a few guests here this morning. If you could respond, making sure that, again, that you can hear me. Thank you. Wonderful. So I'm getting wonderful replies. Yes, I can. So wonderful. The next thing I want to ask you a question about is, the second question is, can you see the presentation? And with that, if you could also respond to that, yes, I can see, that will let me know that you're responding to that second question. Perfect, perfect. So yes, we have wonderful feedback from everyone that they can both hear and see the presentation. So with that, we're going to go ahead and get started. We're starting exactly on time today, which is wonderful. And we're very happy to have you be part of this. Francis Financial, as you know, we're a wealth management boutique as well as financial planning firm, and we're dedicated to providing successful individuals and families with personal financial guidance. Our fee-only approach promises objectivity in our recommendations for each and every client, and it provides some fiduciary loyalty to you and financial peace of mind. Fiduciary, I'll just kind of highlight that. What is a fiduciary? Those of you who are lawyers know that a fiduciary is a person who has a legal obligation to put your interests ahead of their own. We feel that that is very important, and because we are a private company, we can do that. In fact, all public companies, their fiduciary loyalty is to shareholders, and sometimes that can create a conflict of interest, and that conflict of interest is having to maximize profits for the firm, which sometimes is not always necessarily the best interest of the client. So anyways, enough about us. What I want to do is get into our review for the first quarter 2014. I know that that's what we're all here for, and I just want to say welcome, welcome, welcome. We have more and more guests coming and arriving every minute. So welcome with that. If you are interested for any more information about Francis Financial or are interested in possibly learning more about what we do, both ongoing financial planning and asset management, making the most of your money, as well as divorce financial planning. Anyone you might know who's going through a divorce or coming out the other end to start their new life after post-divorce, please do feel free to reach out to me. Go to our website, francisfinancial.com. My email is Stacy, STACY, at francisfinancial.com. So we're going to go over our presentation today. We're going to cover three main agenda items. The first agenda item is our quarterly review. Our second agenda item is our investment outlook, not only for this year, but actually we're going to go out as far as 5 years. And then finally, we're going to talk a little bit about what our current portfolio positioning looks like and changes that we are in the process of making for our clients, and more importantly, why. As far as the first market review, it was a good first quarter of 2014, but I have to tell you, it didn't start out that way. U.S. stocks finished the quarter slightly positive, but they started the year off on a really negative note. In fact, there was a sharp loss in January. Essentially, most economic growth and also some decent corporate earnings, they were the fuel that helped us pull us out of those losses and helped us overcome these worrisome developments, many of these that you've seen abroad. I'm sure that you've watched the news. In particular, Japan suffered some deep losses, particularly in January. This was after an unbelievably red-hot year for Japan. There's also been some ongoing economic concerns about Turkey and Ukraine. The political events that are happening there are having quite a bit of instability overall in the emerging market area. That, too, created more worry and also a little bit of drag in that part of the world. As far as a bright spot were actually bonds. Core bonds were up, and they were strong performers this last quarter. This is quite noteworthy, and the reason why it's quite noteworthy is that core bonds last year, so this is 2013, had their first losses from bonds since 1999. That's an important thing to know because for many of our clients, they're conservative. They are investing because they want to preserve their portfolio. They want to preserve their principal. They don't want to see losses in their investments. And when you think of conservative, you think of bonds. When you think of bonds, you don't necessarily think of losses. So we are very happy to see that core bonds went and performed very well during the first quarter. We'll talk a little bit further on in our presentation about our bond positions. Interestingly enough, even though we saw losses overall in the indexes for bonds in 2013, our actual core holdings for our clients here at Francis Financial in the bonds that we own, interestingly enough, we did not see any losses in 2013. That's something we're very proud of. And if you're wondering why is that, I'm going to take you through step by step and show you exactly why the bond positions we have did not sustain those losses and are posting some really nice gains going forward, not only for this first quarter, but we expect going forward for the rest of the year. So let's talk a little bit about the key takeaways. The key takeaways is essentially one of them, the first one, is weather-related. So all of those of you that live particularly in the Northeast or the north of the United States, we know something special about what happened this last winter. Well, it was one of the coldest, one of the most brutal winters on record. So what does that have to do with what we're talking about today? And that is the performance of the stock market for the first quarter. Not much, you say? Well, actually, that has quite a bit of influence. In fact, economic growth in the U.S. was complicated by this severe weather, and it depressed the short-term data. Unfortunately, the weather and how severe it is outside, it has an impact on the number of times that you and I, the consumer, might leave our home and go shopping or out to eat, even whether or not we can make it to work. These are all things that impact the overall growth of the economy. And so part of the challenge we had in the first quarter was the severe weather that was hindering, dampening, if you will, the economic performance of the United States. The other thing that we saw is that household debt, the debt that you hold, maybe it's your mortgage, your credit card debt, and that your neighbor holds, you have been doing a phenomenally good job of paying it down. In fact, one of the things that we've been very excited about is that the level of debt that we have is far reduced today than it was a year ago. And so one of the very positive things that we are seeing is, again, a much faster rate of paying down debt than we had anticipated previously. Overall, this news and some other news have helped us look at our models again and recalibrate the broad economic scenarios that we look at. And the positive news is that we're modestly increasing our expected returns from equities or stocks. This is new. This is noteworthy. That despite the headwinds that we still have, overall, the fundamentals are increasing so much so, and are positive, so much so that we're actually tweaking our return expectations for stocks, not only this year, but actually over the next 5 years. Now, one thing that we have to be careful about, emerging markets. We're going to talk a little bit more about emerging markets going forward, but we have a good amount of exposure in emerging markets, and our long-term view of emerging markets is very, very, very positive, especially as an asset class. However, our exposure to emerging markets through our bonds is something that over time we're going to start to unwind. We're going to start to essentially take ourselves out of that position. Why is it? Well, emerging market local bonds, that position, has not necessarily performed very well. And when things are not performing well, you bet we're right on top of it, figuring out why is that? What's going on? And going forward, looking at this asset class, it's not an asset class that we expect to perform at the levels we hope it to over the next 1, even as far out as 3 or 4 years. So this is an area where we're going to be essentially diversifying our position. I'm going to tell you exactly where that's going to go in a few more slides. But again, just trying to give you some key takeaways. And the ultimate summary of those key takeaways, number 1, severe weather. Not only was it painful, it was painful to the economy. Number 2, household debt. Give yourself a star because you and the neighbor and your friends have been paying down your debt, putting yourself in a much more financially stable position, much more than we ever had expected. So this helps boost the overall return expectations for the economy, and that's the key takeaway number 3, that we have recalibrated our return expectations upwards. That's a positive note. And so with that, expecting higher returns from equities. And number 4, emerging markets, an area where we still expect some great returns going forward, but in particular the turmoil in Ukraine as well as in Turkey, we're being careful and we're holding back a little bit of exposure and reducing that exposure by essentially unwinding our positions that we have currently in emerging market local bonds. So let's talk a little bit more and really dive into this wonderful situation of what we call deleveraging. So if you're ever at a cocktail party and you want to impress anyone, throw that word around. Say deleveraging. You know, how do you feel about the deleveraging process, and how do you think that that's going to impact the economy going forward? If you say that statement, trust me, people will look at you with whole new eyes. In fact, maybe they'll even offer to buy you a drink to have your insights into the economy. What this chart shows is it essentially shows you the current expansion. And this current expansion is right here. We started this chart going all the way back till September 2007. We wanted to go back far enough and show you where we are with regards to the growth. And you can see we dipped down quite a bit, 2008. No surprises there. You see that dip. And then slowly we're moving forward. We're moving forward, and this is the current expansion that you see picks up from September, from March 2009 was kind of the low of the low that we hit, March 2009, and then you see going forward, we really pick up from that current expansion. What's unique about this expansion is that it's what I call a, kind of a dampened expansion. And you can see that previous expansions from previous years, and we have the 1970 expansion, 1975, 1980, 82, 91, and 2001. All of them, you can see over this time period, all of them had much more rapid expansion than what we're actually experiencing today. And something you may think about, well, why is that? Why have we had a much more dampened expansion today than we have previously? Well, there are lots of factors, but one of the biggest factors is this phenomenon of paying down debt. Paying down debt and again, getting ourselves in much better, stronger financial positions is the right thing to be doing. It's the right thing to be doing, and it's actually the right thing to be doing for the economy. But I'm going to explain to you why it has a negative impact on the economy in the interim. If you have $1, you can spend it many different ways. You can take that $1 and maybe go to the dollar menu at McDonald's. That's probably all that really, there's not going to be too many things you can buy with that $1, but maybe you go and you take it into the dollar menu and you buy something, and you buy a nice iced coffee at McDonald's. That $1 then cycles into the system and supports the workers that work there. It helps potentially McDonald's expand and hire more workers. And you can see how it goes on. And again, you're helping the growth of the overall economy. If you take that $1 and then you use it to pay down, let's say, credit card debt, which most likely is the right thing to do, especially if that credit card debt is at a high interest rate. Maybe it's at 16%. I will tell you, I've even seen credit card debt as high as 29.99%. But by doing that, even though it's the right thing to do, that $1 then goes to pay off that debt. It doesn't cycle into the economy, as we saw with the example of McDonald's. So it's the right thing to do, and that's what all of us smart Americans have been doing over the last several years. We've been taking a look at our balance sheets. We've been taking a look at the debt we have, and we've been paying it down. But again, that money has not gone into the economy. The positive is that we're in a very good position. In fact, what I'm going to show you is essentially, where we are at is much more financially stable today in 2014 than where we were in 2006 and 2007. 2006 and 2007, at the top, at these peaks in this chart, you can see that we were upwards of 130% of our debt versus our income. So we had essentially 30% more in debt than the amount we even made each year. So a good example, if you make $100,000, that means that per average American had $130,000 in debt. Pretty phenomenal amount of money. And so you've seen that particularly in that area, we've come down to a much more reasonable figure, almost close to 100%. Now, that's still scary, of course, but that also factors in things like your mortgage and some other types of debt. So while this deleveraging process or this paying down debt is still ongoing, we're seeing that we're getting to be in a much more financially sound position, and we don't see it as a drag on the economy as much going forward, again, because we've done most of that work already. And we're on track to meet our long-term trend of what we see as a reasonable and financially sound place for average consumers, average Americans to be. In fact, this chart, I'll tell you, this chart may not look like a lot to you. I'm going to take you through it, but it's my favorite chart of the entire presentation, because I have to tell you, this chart shows you that household balance sheets have improved considerably, which is essential for us to be in what we call a normal economic environment. Why is this so important? Well, household net worth. Household net worth, if you look at this is where we are 2014. I bring that all the way over. And these are in billions of dollars. You can see this it says 80,000 here, but again, this is in billions of dollars. Where we were come the end of 2008, you can see this very low drop. Much lower overall household net worth. And we have grown substantially, and you can see the growth of household net worth. This is being fueled by a few different areas. The first is we paid down our debt. That's the first area. Number one. Number two, we've also seen great gains in the stock market. That's helped increase our overall net worth. And third, we've also seen gains in the value of our homes. Our homes are increasing in values. And we are at one of the highest levels of overall total net worth that we have seen. You can see going back to 1990 and even before. It's something to be really proud of. And our household net worth, it increased by almost 14% in 1 year in 2013. That's almost double. That's almost double its historic annual growth rate of 7%. So this is all phenomenally exciting news. Phenomenally exciting news because the average consumer, again, is in a much more financially stable position. We're all in a position helping to get ready over the next several years to really push the overall growth of the economy up because we as consumers can finally spend our money again and we can feel good about it. So let's talk a little bit about our risks. Now, while we've done a phenomenal job of paying off our debt, I have to tell you, guess who has not? Guess who has not? You're right, the government. In fact, the Federal Reserve's balance sheet now exceeds $4 trillion. And that's something to know. And how it unwinds its balance sheets and what the Fed does with regards to interest rate is something that we really need to take into account. If there are sharp increases in interest rates, it's a big risk. It's a big risk because if interest rates go up, it makes it more expensive to buy a home because the interest rate you get on your mortgage is going to be a lot higher. If you own bonds, when you own a bond and they increase interest rates, guess what? The value of that bond you hold just went down. So these are some of the risks that we have. We're worried that if interest rates rise too quickly, that's going to be a damper on the economy, that it's going to reduce the overall growth of the economy. And you may not feel like this is going to impact you. Maybe you're not in the market to buy a home. Maybe you're a more aggressive investor and you only have, 20%, 30%, or 35% of your portfolio in bonds. So you feel like this doesn't impact me. But it will impact you because the overall growth of the economy will impact you every single day because that growth of the economy will impact how the stock market performs. And trust me, that's something that we all want to think about, that we all need to know. As far as where we are and the debt that we have 25% of GDP right now for the Federal Reserve balance sheet assets. This is something that we again need to look at and we need to watch very, very closely as we go forward. So one of the questions you may have is, with increasing interest rates, what does that really mean for the economy? What does that really mean for the overall housing? Well, this is a great chart that we put together for you. We went back to August 2011. And in this chart, you're going to see the overall affordability of homes and where the current mortgage rates are for a 30-year fixed mortgage. So here we are, we're at, for a 30-year fixed mortgage, about 4.4%. Not so bad. However, I do want to remind you that there were times going back to 2012 where we saw interest rates of down, well almost to 3.3% for that same mortgage. So from going 3.3% back in November 2012 all the way to 4.4%, that can make a home much more expensive. So that's one of the headwinds that rising interest rates have, because as interest rates go up, mortgage rates also go up. Now another trend that we need to look at is that the rate at which home prices have been accelerating in the recent years, it's slowed. So you can see, coming back from our recession, we had June 2012, we see that it started to really pick up as far as growth in the average price of your home. And over the last couple years, starting in February 2013, the acceleration pace has slowed. And that's a positive thing. It's allowing houses to continue to be more affordable. So this is a positive. This is a positive situation with regard to real estate. So we have the headwind of interest rates going up, mortgages, interest rates going up, and because of that being more expensive to own a home. But we also have the positive trend that overall houses are staying relatively affordable. So now I know what you're thinking, because there are definite pockets, definite areas in the United States, one of them being my own hometown here in New York City. There are areas where homes are starting to not be affordable, that the growth rates that we're seeing are unbelievably high. And there are different reasons, but I'll give you a little background on what's happening here in New York. New York, we're seeing very, very, very strong demand for homes, particularly in the city, and a lack of inventory. There's just not enough people putting their home on the market. And so there's this demand chasing too few homes. And that's what's essentially making this market a little bit harder. Doesn't necessarily reflect this national average that we see here in front of us. So we talked a little bit about interest rates impacting mortgages and housing, but what about your bonds? Interest rates go up, bond prices go down. I remember that from studying in my sophomore year in college in our basic 101 economics class. And when you read and hear something like that, I remember, of course, memorizing that formula, but it really didn't mean a whole lot to me until many years later, and I was in the market and really seeing how this formula worked out. That when interest rates go up, bond prices go down, and you potentially could lose money. So what I've done for you is we put together this wonderful chart showing our bond positioning. And what we've done is we've invested in bonds that have a lower risk from rising rates. And how you read this chart is very simple. Here along the bottom, we have the interest rate sensitivity. 6 being the most sensitive to interest rate with the most potential for loss if interest rates go up. And then here over on the left, 0 being very little, if not any impact by interest rates rising. Here we have yields. The higher the yield, the more expected return you have as well. So where we are at, we've included an index. We don't invest in this, but we included an index just, again, kind of help you reorient yourself to what this chart means. So this is the Vanguard Bond Market Index. And you'll see where it is. It has a moderate yield. But what's more important and more worrisome is that it has a much higher sensitivity to interest rates. So what happened last year in 2013 when we saw increasing interest rates? This indice lost money. This indice lost money. Where are we at for our clients? What are some of the investments that we use, again, based on the risk tolerance and based on the goals of their portfolio? We are more so here. And with this, we did not see any losses in our bond portfolio. In fact, some of our investments have performed so well that they outperform the Vanguard Market Index outperformed by 7%, some 8%, others as high as 9%. In fact, some real strong earnings during this last quarter: Double-Line Total Return, Loomis Sales Bond, PIMCO Unconstrained, and Osterweiss Strategic Income. They are all funds that have collectively added material value so far this year. And I actually was out in California meeting with the head of Osterweiss, the research department, this last week, and it was phenomenal to hear again how serious they are taking the threat of interest rates. And part of the reason why they've been doing so well is because they've been investing in bonds that are less sensitive to interest rates. We know that that's important. Essentially, if you see an oncoming train, step out of the way. We know that oncoming train right now, it's interest rates. So what does this mean? I've thrown a lot of information at you. What does this mean? Well, it means that what we've done is we've put together a base case. With all this information, we've put together a base case in a way that we can best position our client portfolios, such as the odds are the highest that they can be to meet their risk as well as their return objectives. Of course, there's a range of probable outcomes, but we do the best we can based on this information to understand what is our base case. We definitely consider other scenarios as well. Here we have a bull case, a much more positive case. In particular, in the bull case, you would see much higher stock and equity returns than what maybe we're expecting over the next 5 years. And then we have the bear case. The bear case is that we fall back into a recession. It could be deleveraging in deflation from Europe or China, other economic shocks, geopolitical situations, a federal policy error. It could be many different things. But what do we expect most likely to happen? It's our base case. And I hope that gives you a little bit of peace of mind. In particular, most people are just very happy that we're not expecting to go to that bear case. We've already lived through that, and I don't know about you, but I feel like once every several decades is definitely enough. What we've done, we've put together this chart for you. It's quite a detailed chart, but I'm going to walk you through it. What this chart does, it shows you the estimated asset class returns across all of our scenarios. And our base case scenario is that bold horizontal bar. That bold horizontal bar, it indicates our return estimates for our base case scenario. So if we're looking at, for example, European stocks, we're estimating that our return is roughly about 8%. That's what we're expecting, an 8% return each year over the next 5 years. For U.S. stocks, you can see that it's closer to like a 4%. And you can see some of our bond exposure here too. Now, what's unique about this, you see quite a bit of a range. And in the bear scenario, we're seeing at losses of 4% each year over the next 5 years. In the bull scenario, that more positive scenario than we expect, you're seeing returns of around 11, almost upwards of 11% each year over the next 5 years. As well as you see this in European stocks and emerging markets. What I want to point out to you is that, overall, our base case is that it's going to be a good next 5 years. We're expecting, overall, a positive return from the market. But what's unique about this time period, more than we've seen in many, many years, is that the range of outcomes is quite big, quite significant. The range for European stocks for that bull case, you're getting a 15% return each year over the next 5 years. Whereas the bear market for European stocks right here, a 4% loss each year over the next 5 years. And again, our expected is about 8%. This is significant. This is significant in that we are seeing much larger ranges than we normally do with regards to the potential outcomes and the potential returns that we see in our portfolio. And so what we've done is we've made sure that we have overall very diversified exposure to make sure that no matter what our range of outcome is, that our clients have over time, not on a year-to-year basis, but over time, a positive investment return. What we've done, we've narrowed it down a little bit here, a little bit more closely, so you can see, our base case versus the bull and the bear. These are the averages that we expect. And again, we're tweaking our portfolios to take advantage of. As far as the summary, so this goes through, we're making some changes. We're making some changes. And the first one we've talked about before. We're essentially unwinding and selling our emerging market local currency bonds right now. We're doing it for two reasons. Number one, our additional risks with emerging markets. That's something that we think about. And then also, number two, the risk of holding emerging market bonds is much higher than we have today, is much higher than it was maybe even a year ago. So with that, it doesn't really pay out. With the increased risk of holding emerging market bonds and what we expect to get as far as return from them over the next couple of years, it doesn't necessarily make sense. So this is something that we're doing, again, unwinding in each of our clients' positions. It's something that's not an easy thing to do. We have to go through, understand, is this something that we do right now, or do we hold off because of tax reasons, rebalancing reasons? There are a lot of pieces that go into it. As far as where does that money go? If we were to be selling that proceeds of that, where would that money go? We're putting that money in U.S. and developed international stocks. And that's partially because our return expectations for U.S. and developed international stocks actually have increased quite a bit. In some of our more conservative portfolios where we have a lot of bonds, we're selling off some of our bond positions and putting them into floating rate loans. I don't know if you remember, but I'm going to show you this wonderful chart again. So floating rate loans right here, you can see they have almost no sensitivity to interest rates. And so for those portfolios where we have a lot of bonds, we're concerned, and we really do want to, again, make sure that there's not any losses. And so with that, we are adding more exposure to floating rate loans, like that DWS floating rate investment that we really, really like. So we're making some tweaks in more conservative portfolios to make sure that we're all set. So one of the questions that you may have, why are we selling out of emerging market local bonds and not selling out of emerging market equities? That might be a question that you have, and I'll tell you the answer. The answer is that the return expectation for emerging market equities is anywhere from on the very low end, 5%, to more on the higher end, about 12% each year over the next 5 years. Those are some really nice numbers. And on the low end, we included a lot of factors, one of them being the risk that we see in China. We also assume a very low growth rate for the region, which, to be honest, is not something that we expect. And so we expect some really high returns from that area. So it merits the fact that there's a little bit more risk. But with emerging market local bonds, you have that same risk, but the types of returns that we expect from emerging market local bonds, because again, they're bonds, they're not stocks. These bonds, we expect more minimal returns. Not so exciting, maybe a return of, on the very high end, 6% or 7%. And on the low end, a return of 3%. So, again, when it makes sense in a portfolio, we're unwinding that position because the returns we expect from there, well, they're not bad returns. Because the overall risk of emerging markets has gone up, again, it doesn't pay to play. So let's talk a little bit about this return expectation for stocks and also why we are adding more money to stocks, but we're not overweighting. You may have noticed that the stock market has done pretty well. In fact, look at this chart. This is the S&P 500. We've had a really nice growth over the last couple years. And we're at a pretty nice level. stock prices have significantly outpaced, however, earnings growth in the past couple of years, meaning that returns have largely been a multiple of expansion rather than earnings growth. This is a fancy way of saying that earnings growth, these are the gray bar chart here, the gray bars here, typically as earning growth goes up, you can see this here, direct correlation in September 2010, December 2010. I'm sorry, June and September and December. You can see that in 2010 that it had a very close correlation, that as earnings growth of companies went up, well, so did the stock market. But see where we're at. We have earnings growth down here, and we have the current more frothy levels of the stock market at this higher level. What does this mean? Should we be concerned? Not necessarily concerned. It just means that we are continuing to be somewhat underweighted to U.S. stocks because we feel that U.S. stocks might still be overvalued. They might be overvalued. Now, fundamentals of the economy are increasing, but we don't, unless there continues to be more positive fundamentals going forward, again, we are wary of putting too much money in U.S. stocks in particular because of the high levels that we're seeing today. So while we're adding a little bit of money from our bond position, we're not throwing the whole boat in to U.S. stocks. And what about emerging markets? And why do we feel that emerging markets, particularly some of the losses you saw, particularly in 2013, why do we expect that emerging markets are going to be a good place to put your money? Well, I'm going to show you something that's quite interesting. So the global share of GDP is this chart here. And emerging market economies actually make up about 50% of the world's GDP, but only about 11% of global market cap. We believe that this discrepancy is going to narrow significantly as emerging markets fundamentals continue to improve over the long term. And why do we expect the fundamentals to continue to improve? Well, emerging market countries have a lot of headwinds, or a lot of winds at their back, moving them forward. Number one, it's demographics. They have largely a very young population, and there's an ongoing knowledge transfer from the developed world, the United States, back into these countries. Also, as their incomes in these countries increase, also their growth is going to increase because they're going to become more powerful consumers overall. And so we're going to see that the overall net worth, the global market cap, the market cap of developed nations is going to continue to get smaller and smaller as emerging market countries' global market capitalization becomes greater and greater and greater. As such, we believe that long term, there's definitely an opportunity in emerging markets. So as far as next steps, what to think about, in conclusion, I have to tell you that 5 years after the worst financial crisis since the Great Depression, we feel extremely blessed and fortunate to be where we're at. Overall, the economy and our clients would be in a much worse financial shape if all the concerns so many economists had actually came to pass. Instead, we definitely still have a laundry list of concerns and uncertainties that are always going to be factors in our investment decisions. And right now, the biggest risk is that stocks, while they're not expensive, they're definitely not cheap. And so we're being careful to make sure that we're not putting all of our eggs in one basket. As you saw, the range of possible outcomes and possible returns among all those different asset classes, it's unusually wide. It's unusually large. And if anything, now is one of the most important times for investors to have a long-term perspective because you're going to see volatility. You're going to see ups and downs in your portfolio. Some asset classes are going to do better. But overall, the most important thing is to make sure that you are diversified with many different asset classes and that you understand what the expected returns and risks are of each one of those asset classes. To make sure that the portfolio you have 100% reflects your risk tolerance, what makes you feel comfortable at night, and also a portfolio that's going to help you get to your goals so that you never have to worry about outliving your portfolio, that you know that portfolio is going to be there to support you in good times and also in bad. So with that, I want to say thank you. Please let us know if you have any questions. We're here to answer them for you. Again, this is Stacy Francis Financial. I'm President and CEO and here to help you. So if you yourself are interested or know of other individuals we might be able to give a second opinion on their financial situation, we're here. It's free and it's something that we all deserve. Thank you so much for your time, and I wish you the best. We'll have this up on our website as well for a recording so that you can access this, and we'll have that definitely by the end of this week. Thank you again.